Imagine beating Wall Street's profit expectations, only to watch your stock crater 14% to a 52-week low. That's exactly what happened to Janus International Group, ticker JBI, in their Q2 2026 report. They posted an adjusted EPS of 17 cents, which, beat the 14 to 15 cent consensus, but revenue came in at 233.5 million, missing the 238.8 million mark.
Yeah, and the real nail in the coffin was that slash forward guidance. I mean, they cut full-year revenue expectations down to a range of 925 to 945 million.
Ouch.
Right. And they dragged adjusted EBITDA down to between 150 and 170 million.
So, it's just a brutal reaction from the market. Today, on our deep dive into the source material, we're unpacking this earnings report to figure out if the sell-off is an overreaction or a serious warning sign for you.
Exactly. And to understand that top-line miss, you really have to look at the severe split in their segment performance.
Which was huge.
Yeah, on paper, you got self-storage revenue up 15.4% and new construction jumping 20.3%. But their commercial segment, it completely fell off a cliff, dropping 21.2%.
Wait, 21%? What's the actual mechanism behind that sudden drop?
Well, it comes down to severe demand destruction for sheet doors in pre-engineered metal buildings.
Yeah.
The macro environment is essentially, freezing up those specific commercial bills right now.
Okay. Yeah, I hear you on the commercial drop. But I actually want to push back a bit on that 20% growth narrative for new construction.
Oh, because of the acquisition.
Exactly. If you read the fine print, organic sales in new construction were totally flat. That entire jump basically came from their $19.2 million acquisition of Kiwi II Construction.
Right.
It's like bragging about losing weight because you took off a heavy backpack, The organic core of the business didn't actually improve at all.
That's a fair point. I'd argue the acquisition was, a necessary strategic move to grab market share in a tight environment.
Yeah.
And you're absolutely right that it masks the underlying reality.
Yeah, you strip out Kiwi II, and their core organic engine is just idling.
And that idling engine is exactly what triggered the biggest red flag in this quarter's numbers: massive margin compression.
Right, let's talk about profitability, because adjusted EBITDA dropped 18% to 40.2 million.
Yeah, it's significant.
We're talking about margins shrinking from 21.5% down to 17.2%.
Which is a textbook negative product mix scenario. Those commercial sheet doors that saw the 21% drop, those are Janus's legacy breadwinners. They carry fantastic margins.
Oh, so they're selling less of the good stuff.
Exactly. Meanwhile, the segments that are actually growing, partly fueled by that Kiwi II acquisition you mentioned, they carry noticeably lower margin. So the reality is they're selling more of their lower margin stuff.
Which naturally drags the overall profitability way down. And,
Yeah.
CEO Ramey Jackson didn't mince words on the earnings call. He pointed the finger directly at the macro environment.
Right, specifically calling out stagnant North American housing and delayed customer projects.
So what's the primary structural risk here moving forward for investors?
Well, we aren't necessarily seeing customers cancel projects outright. Instead, they're pushing timelines out. They're waiting for better financing rates to build or, waiting for the market to absorb the existing storage capacity.
Just kicking the can down the road.
Yeah, and if North American new construction enters a prolonged freeze, Janus's physical steel business is going to remain under intense pressure.
Is there any silver lining here at all? Because the physical construction side looks pretty grim.
There's one major bright spot management pointed out. Their NOCO smart entry platform just surpassed 500,000 installed units.
Oh, wow. That's their high-tech play, right? The keyless digital entry systems for storage facilities.
Exactly. And it's fascinating because it fundamentally changes the economics of their relationship with customers.
Because it's recurring.
Yes. It shifts them away from a one-time physical sale toward high-margin, recurring software revenue.
Which is a potential lifeline that doesn't rely on pouring new concrete or erecting new steel buildings.
Right. Which brings us to the ultimate question you really have to ask yourself looking at these numbers. Will Janus's pivot toward this high-tech, recurring revenue with new K be enough to offset the structural slowdown in physical commercial construction?
Or is the 17% squeezed margin the new normal?
Exactly.
And taking it a step further, if Noki does become their dominant growth engine over the next few years, does Wall Street eventually have to stop valuing Janus as a legacy industrial steel company and start pricing it with a premium tech multiple?
That is the tension right there.
Right.
A tech valuation multiple would be a massive upside, but only if they can survive the gravity of their legacy core in the meantime.
There's definitely a lot to keep an eye on in the coming quarters. Make sure to follow the show for your daily earnings coverage so you never miss what's actually hiding behind the headline numbers.